This is White Coat Investor Podcast number 127, Mega Backdoor Roth IRAs. You know, I've been hanging out in the White Coat Investor private Facebook group. So you can find that at facebook.com/group/whitecoatinvestors. And trying to figure out why something happens in there that doesn't happen necessarily elsewhere in some of our other communities, like our subreddit. For those of you who are into Reddit, that's a great place to check out a community of like-minded individuals, or on the WCI forum that we host on our website itself. And the reason why I couldn't figure it out for a while is because I access the Facebook group through my laptop. I go to Facebook, I click on the group, and I go in there and I see all the questions that people are asking together, and I go from one to the next to the next. But I think I've realized that most of the people in the Facebook group don't access it that way. The questions and the topics that come up in there just show up in their feeds. So they're between Aunt Millie's cat pictures and whatever else you happen to be, a member of, or what your friends are posting on Facebook. And so they just come up randomly. Because sometimes some of the questions we see, as well as the answers that are given in that group, are less than ideal, let us say, perhaps less than I would expect from a financially literate population. And so I've been trying to do a few things to improve that. The first thing is I signed up all the people in the group whose email addresses we had for the White Coat Investor newsletter, which gives them Financial Bootcamp, that 12-step email series that you get emailed to you once a week for 12 weeks. And I think that helps bring people up to speed that are just finding the blog. And I'm hoping what it will do is bring the people in the Facebook group up to speed so they kind of have the basics of financial literacy and can then talk about the esoterics they want to talk about in there. Because I often see questions in there where people are asking about investments, and all of a sudden people are chiming in, telling them to buy individual stocks and Bitcoin and whatever crazy thing they're finding of the investment du jour. So what I want to ask you to do is to help me in this effort to actually go to the Facebook group and answer people's questions in a financially literate way. You know, they're the typical questions people ask about their investments and their retirement accounts and their disability insurance and asset protection and those kinds of things. You know, we tend to talk about the same 50 or 100 questions all the time in these online communities. But if you can help in that community, I would appreciate that. Again, you can find that at facebook.com/groups/whitecoatinvestors. Also, put in a plug for the subreddit and the WCI forum. Also great places to discuss personal finance for doctors and other high-income professionals. Our quote of the day today comes from George Soros, who said, "If investing is entertaining, if you're having fun, you're probably not making any money. Good investing is boring." And I agree with that. You know, after a while, this stuff should be pretty much on autopilot. If you're on a financial plan, you're working toward your financial goals, there shouldn't be something new to learn every month, something new to understand every month. This stuff eventually should be pretty autopilot for you. Our sponsor today is Earnest, one of the student loan refinancing companies. Save money on your student loans by refinancing with Earnest. Choose custom terms to fit your budget, like pricing your exact monthly payment or selecting fixed and variable rates. Earnest precision pricing matches your custom term with a custom interest rate, saving you even more money when refinancing. You won't be passed off to a third-party servicer nor penalized for making payments early. Your family is always protected with loan forgiveness in cases of death and dismemberment. The minimum amount to refinance is $5,000 and the maximum is $500,000. So the chances of you being outside those two limits is pretty low. That's pretty broad as these companies go. But there's more. If you sign up to refinance your loans and actually complete a refinance, after going through this link, whitecoatinvestor.com/refi, that's REFI, you will get $500 cash back. I would encourage you to take that $500, put it toward your loans, and pay them down a little bit faster. So refinance your loans today with Earnest, whitecoatinvestor.com/refi, REFI. Thanks so much for what you do. Every day you go into work and you do something difficult. That's why you get paid so well. You're a high-income professional, whether you're a physician or a dentist, a podiatrist, maybe you're an APC. I don't know what you do for a living, but chances are it's difficult. And that's why you get paid so much. And that's why you're listening to this podcast, to try to stop doing dumb stuff with your money. So I want to thank you for what you're doing that's hard and the years of preparation you put into it. I had a difficult shift yesterday where it seemed like every patient that came in had some sort of psychiatric problem that I had to deal with. For example, I had this lady that had been brought in by the police because she was walking around naked all over the place, And so they brought her in, and she continued to walk around naked around my emergency department. So I've got the kids and my other patients totally being scarred by this elderly lady walking around buck naked. And you know what? Most jobs don't have to deal with that stuff. And maybe that's why we get paid so much, because we do. So thanks for what you do. I know the paycheck is nice, but it's not always enough. And after a while, especially after we become financially independent, we're not really doing it for the paycheck. And so I appreciate what you do. I know your patients do as well, and their families, even if sometimes they forget to tell you. By the way, if you need a financial advisor, I want you to check out our new revamped recommended financial advisors page. If you need a financial planner, or if you need ongoing investment management, that's where you can find people that can help you. There are also people there that can help you with, implementing retirement plans for your practice. And so we've been featuring some of these folks on the podcast. We're bringing them on one at a time of our 10 featured advisors there, and let you get to know them a little bit better. But the entire list is some great advisors that I've gone through the trouble to vet for you. Look at their ADV2. I've read through their applications that I make them fill out. And I've taken feedback from white coat investors who have used their services and got back with me and let me know what their experience was like. And so these is a list of some of the best of financial advisors out there. These aren't people that are going to hose you and sell you crummy stuff you don't need. They're people who are going to give you the advice you need at a fair price. So if you need an advisor, that's perfectly fine to use an advisor. Just make sure you're getting good advice at a fair price. And the easiest way to do that is to go to the White Coat Investor recommendation page. We have a guest today on the podcast. He is one of our featured financial advisor partners. It is Aaron Millage from Targeted Wealth Solutions. Targeted Wealth Solutions is an independent fee-only financial planning and investment management firm founded by former U.S. Air Force pilots. Their goal is to build the financial latitude in your life so you can pursue your passions. As fighter pilots, they served alongside some of the best flight surgeons in the military and saw how being in a demanding career with a large amount of peripheral responsibilities caused stress over the lack of time available to spend on professional and personal pursuits that really mattered to their flight surgeons. They started Targeted Wealth Solutions to shoulder financial and business planning burdens so that their clients could get back to doing the things they were most passionate about. They can be reached at info@targetedwealthsolutions.com or at their website, targetedwealthsolutions.com, or by phone at 303-800-8179. So Aaron, welcome to the White Coat Investor Podcast.
Thanks for having me.
So let's start with just a little bit about you and your firm. Why did you become a financial advisor? What was the story there?
I'll be the first to tell you that the financial advisory career found me. And I think that most advisors would tell you, I got into this job because I love numbers. And I think for the most part, that is a necessary condition. And certainly, I could go on about a passion for finance that kind of developed over the course of my MBA. But, I don't think that's sufficient in answering the question of why do we do this? What rolls us out of bed in the morning? And how do we translate, numeric literacy to the value you add to clients? And so when I look back at my own life and kind of reduce it down, two elements really stand out. The first was when our middle daughter was born. We found out she had some significant special needs, and it was at the time kind of the peak operational tempo of my Air Force career. And so as a family, we wanted to figure out how do you take financial resources, how do you plan around that, how do you develop kind of this action of stewardship where you take these resources and you employ them in such a way that it expresses what's most important to you. As a family, how we wanted to spend more time together, how we wanted to build the supports and services and education for our daughter. And it was really the first time that we kind of took pencil to paper and went through the deliberate process of, okay, well, this is what we have as a financial resource. How do we use it to express our values? And then second to that, I grew up in a small business family. My dad, literally built a business around the kitchen table when he was laid off from the gas company. He was the junior stakeholder in this company that would eventually become a significantly large company in the middle market, regionally speaking. And so I was going through the MBA and was able to see this transaction occur where a private equity firm came in and acquired my father's company. And that was neat on the surface, right? At face value, hey, look, it's a case study, a real life case study that I know all the players. Watching the valuation, the deal terms, and the diligence But as I took a step back, nobody was actually sitting on the side of the table with my parents, right? And so nobody was answering the question of, well, how do we add in covenants so that ownership doesn't get diluted as this company takes on new capital and grows? How do you navigate this liquidity event in a tax efficient manner? What does this do to long-term goals? What does this do to your kind of life? Nobody was there answering those questions, which is interesting because it seems like everybody has a guy, right? A guy that sells you insurance, or a guy that does your taxes, or a gal who does your investments. But that person didn't exist for my parents, and so philosophically, I think that those two elements, something very personal and near and dear to my heart of how, as a family, we use our finances to pursue what's important to us, and then seeing that dearth of kind of trusted advisors that are out there to help clients in kind of navigating complex situations are really those are the sufficient conditions that kind of take this, well, yeah, I love numbers, but what's the next step? What lens do you look through that kind of paved the way really for the financial advisory career to arrive on my doorstep, so to speak?
So let's talk a little bit about your firm, Targeted Wealth Solutions. What do you view as being unique about your firm compared to others?
I think that most people would say, oh, you guys flew fighters in the Air Force. That's neat. And I don't want to be dismissive of the intangible qualities that military officership brings to an industry that is often looked at with a skeptical eye, and probably with good reason. But, as clients start to work with us, I think really what stands out are three things, and it's kind of broken down into structure and scope and approach. Structurally, we've always worked as an ensemble. And so the other co-founder, Brandon LaValle, and I have always worked as a team in every client relationship. And so, if a prospective client goes to the website and, they schedule a complimentary consult, they're going to either talk to Brandon or me. And so we're kind of the de facto persona in that relationship. But behind the scenes, we're both working and tackling that financial plan. I'm a big believer and I think that the true antidote to hubris is a dissenting opinion from a colleague. And so I think that the way that we approach planning investment management as an ensemble allows us to attack assumptions and elements of the plan from all angles, and it kind of results in a robust outcome for clients. Along those same lines, the scope of what we do, because we target on really this kind of notion of the entrepreneurial spirit. We don't just say that, well, you got to be a business owner. It's anybody who really wants to take their finances and build optionality into their lives in order to pursue some passion or express some value. That opens up a whole world of domain expertise that we touch on. So business ownership to tax strategies to, managing variable income in the business, so, to get your cash conversion cycle under control, to everything in between that the kind of normal personal financial advisor touches on. That's the extent of our scope. And so it's broad and it's deep, and we might not have the answers off the top of our heads, but I think we're the folks who are going to roll up our sleeves and run that question to ground to get the answer, to build it into the plan. And then the third element is really the approach, which is just a kind of a knock-on effect of the scope. So in combat aviation, you live and die by the planning that you do. And so it's this continuous cycle of you plan the mission and you brief the mission and you execute the mission. You debrief what you've learned, both success and failure, and that feeds right back into the next iteration of the planning cycle. It's wonderfully kind of systematic in the way that it looks at how to generate effects or desired end states at the most cost efficient or risk limiting way. And so it's a framework that's easily applied to financial planning that I think that the current state of financial planning efforts kind of misses out on. And just the output that the normal financial plan produces is more of a report card of, hey, you get an A+ in retirement savings, you get a C in your risk management or insurance. Our approach to planning adds a little more dynamic element, certainly in the areas of contingency planning and addressing issues before they actually become issues.
Now, you two have likely got some special insight into the lives of military physicians. What do you see as being unique about the lives of a military doctor compared to other doctors?
I think that, and so that, our special insight, I don't know is that special, but I will say that it was an incredible relationship to have in a flying unit, because every flying unit has a flight surgeon assigned to that unit. It's on your manning document, and so you're working. You're briefing, you're deploying, you're going on temporary duty assignments with your flight docs. And if you're fortunate enough to fly in an aircraft with multiple seats, your flight docs are flying with you. You build this warrior ethos with these physicians. And I say that was an incredible opportunity to kind of form those relationships. And certainly through those relationships, we learned that not only that military physicians are, they're under the same difficulty of translating the military lexicon to civilian life when they make the transition. And so there's a quantitative element to that, and there's a qualitative element. And the quantitative element is the fact that obviously as a military physician, you're probably, most likely, underpaid relative to your market rate compensation in the real world. But at the same time, you have these benefits that, some are tax-free, some are location dependent. Obviously, you have a present value of a pension that you're factoring in when you kind of look at, okay, well, I want to leave the military, transition to the civilian world. How do I make those apples to apples comparisons when I look at my financial lives? And then from a qualitative or intangible side, I think it's super unique, the life of a military physician where, not only are you an officer first, and so you're responsible for in the Air Force, equipping and training these younger airmen underneath you, but again, you're building this warrior ethos alongside your professional capacity. You're deploying, you're put in positions where, the definition of first do no harm is put to the test, right? I mean, I think you run into any military doctor who served at a deployed operating base and just the scope of our current military operations. And they have a story of where they're treating, an American service member right next to an enemy combatant. Those sort of elements of the military profession are very difficult, I think, to make that transition from military service to civilian service. And so that's a talking point when we talk to our military physician clients about, hey, this is what the outside looks like. Have you considered this? It may not touch on your financial life, but it's something definitely to consider that's unique to military physicians.
Yeah. Tell us about the fee structure at Targeted Wealth Solutions and why you guys decided to do it that way.
Well, I'll be the first to tell you that sometimes or I should say the regulator tail wags the fee structure dog in the way that our state regulators view verbiage. And, they go through these periods of liking certain words and disliking other words. And what we found is really if we give the client, hey, this is what we're doing for you. This is how many hours on a yearly basis or this project is going to take. And this is kind of the aggregate total of that fee. It's really irrelevant to us how we express it in terms of percentage of AUM or a flat fee or a non-recurring project fee. That's really kind of up to the client of what makes sense to them. And so we have an AUM scale. We can do flat fee. We can do, again, project or hourly fee. But at the end of the day, it really comes down to, our value is largely, or the fees associated are largely determined by the amount of work that we do for the client. It's just oftentimes easier to explain that directly to the client versus trying to capture that in the ADV or disclosure document in a way that satisfies kind of the regulator and what words they want to see. But that's a long way to say that we can tackle that multiple ways, and our fee structure is flexible because we're independent, and it just makes it easier when you're expressing the cost in terms of the work or the output per hour that we're doing for a client.
And so it sounds like, looking at your ADV2, how you expressed it to the regulators, you can do financial planning and consulting for $150 an hour, and then ongoing wealth management for an AUM fee that starts at 1%, but starting at $400,000 drops to as low as 0.4% per year, depending on the level of assets. Is that still the scale you're mostly working with?
Yeah, and I throw in a caveat to that, because we're finding that, for instance, in Colorado, where we're domiciled and regulated, the term retainer is sort of carries mixed feelings. But I think we're seeing a shift in our own practice to move towards a flat fee. Again, it's simpler. I think it's a little more transparent. And that's not to say that, you can't reconcile an AUM structure with a flat fee. But I think that's, on an industry whole, that's where you're going. And certainly, how you arrive at that fee, I think that the fairest and most transparent way is to use that hourly rate and say, hey, this is what we're doing on your behalf for the year. This is the hourly rate. Ergo, here is the fee as expressed, however is most comfortable to the client. And obviously, the ultimate caveat is that everything is negotiable based on the complexity and kind of the unique situation that everybody brings to the table.
For those just tuning in, we're talking to Aaron Millage from Targeted Wealth Solutions. Let's get to some of your questions now. Our first question's coming in off the speak pipe today. This is coming from an anonymous resident. Let's listen to it now.
Hey, Dr. Dolly. Thanks for everything that you do. I'm a PGY3, and I had a question about 401ks. Currently in my residency, I have a 401k that offers Roth and pre-tax contributions with no match. After I finish my PGY3 year, I'll be joining a primary care practice in August of 2020. They do offer a match, and I guess my question primarily is, when I have from January to June in residency, should I be contributing to my 401k as a resident, trying to get as much into Roth as I can, or should I wait until I'm employed by my new employer in August to start contributing to my 401k? I don't want to miss out on any potential extra income from getting the match with my new employer, but also want to take advantage of all the Roth contributions that I can make. Will contributing to my Roth as a resident, let's say $1,000 a month, prevent me from getting the full match? I realize that I can only contribute $19,000 in a year, so just trying to figure out where best to allocate that $19,000. Thanks.
So basically, Aaron, sounds like they're asking, should I hold off on making 401k contributions the year I leave training in hopes of getting a match from my new employer? What would you say to that client?
Obviously, probably the first thing that comes to mind in most folks is, well, I can create a closed form solution to this problem if I know how much I'm going to make. That, however, is inadequate, right? Because every plan is materially different. Even, the language in the summary plan description may look fairly boilerplate across the landscape. Your ability to participate in the plan may be limited based on a waiting period, right? And so employment may start on January 1st, but you can't actually participate in the plan and receive the employer match until 6 months down the road. And so before, I would say anything to hold off on making contributions or, whatever, to get a hold of the plan documents if able. Take a look if that's even an option of first day of employment. Are you eligible to enroll and participate in the plan? And then understand how that kind of factors the decision calculus from there. If there is a waiting period, obviously, and depending on how tight the labor market is and kind of your willingness to negotiate, I would say put that on the table as far as, hey, talking to your new employer and say, hey, your plan excludes participation for the first 6 months. That's costing me X amount of dollars in employer match rather. How can we kind of create an equitable solution from an all-in compensation perspective to kind of make up for this poor plan design, for lack of a better term?
Yeah, I think that's exactly right. I love your idea of taking that to the negotiating table as well and using it to negotiate a little bit better offer. Because it's not unusual at all. A lot of people don't realize this if they've never had a retirement plan. Like lots of docs coming out of training, they've never used any sort of retirement plan. They don't realize that when you started a new job, a lot of times the way the 401k documents are written is you can't contribute for 6 months or a year. So if you're coming out of training in July thinking, okay, I'm going to max out my new 401k, they may tell you, no, you can't contribute at all until next January, or we're not going to match you at all. So I think the bottom line is before you decide what to do with your old resident 401k for that year you leave residency, is figure out what's going on with the new one before you leave. You just got to get the document, or you got to talk to the employer or call HR or whatever and just say, hey, am I even going to be able to contribute to this? And is the plan any good? And is there a match? And because all that stuff matters, right? If there's no match at either one, you might as well put it into your residency one, right? It doesn't matter for that year. But if you're going to get some match, if you put money in there in September and October and November, but you wouldn't be able to contribute because you already maxed out your employee contribution in the first half of the year, well, you just left money on the table. And so I think the key is just get the information before you leave residency so you know what to do. Once you have that information, it should be a pretty easy decision as far as how much you contribute. I think another thing a lot of people don't realize is that they're still in a pretty good tax bracket that year they leave residency. Yes, it's going to be higher than as they, a full year of residency, but most of them are leaving in July. And so they got a year of resident income and a year of attending income. And the next year is going to be all attending income. And so it's likely going to be a higher bracket. And so that's a great year to do Roth contributions. If you had a tax deferred retirement account, maybe even do a Roth conversion of that in that year. It's kind of your last year for a long time of not being in the top bracket, not being in your, well, not necessarily the top bracket, but your peak earnings bracket, if you will. And I think that's a really key planning point for a lot of people. It's not quite as good as those people that come back to med school from another career. I mean, med school is a great time for Roth conversions, because you have no income. You could do huge Roth conversions and pay nothing for them as a med student. But still, even those years of residency or the year you leave residency or fellowship, there's some opportunities there. All right, let's take our next question. I think we got 2 here, and I'm going to have a couple more later in the podcast from Tim from San Francisco. So Tim from San Francisco, thank you so much for coming on the speak pipe and leaving us questions for the podcast. We're really going to be featuring you today, but let's listen to his first question here.
Hi, Jim. This is Tim calling from San Francisco. I had a question because my wife and I are both doctors, and so we have maybe more than average asset protection concerns. Does it make sense for us to maintain separate taxable brokerage investing accounts for asset protection purposes? Thanks.
Okay, so this is an interesting idea. Tim is talking about having separate taxable accounts, one in his name, one in his wife's name, to try to maximize asset protection. What would you say to Tim when he brings this idea to you to boost his asset protection?
It's in the similar vein as the previous question, right? That there is an incredible amount of legwork and diligence to be done because asset protection, it's all or nothing. And so really the kind of the better way to look at it is 3 legs to a stool or, whatever support. The first is looking at it through the lens of risk transference. And so I want to understand what insurance I have, what that it covers, what it doesn't cover, to identify the gaps, identify the assumptions built into the coverage there, make sure that my policy limits are adequate for my situation and certainly the amount of assets that I have to protect. The second pillar or leg to that stool is we're kind of getting into the operation of law here. And I never want to rely on operation of law to keep a creditor away or solve my asset protection plan in its entirety, right? I want to rely on something that a lawyer wrote for the benefit of another lawyer to protect what I own. And so to that end, I think that's the point where when you understand your insurance, you understand how we're going to transfer risk. Then we go to an attorney and bring in, this is where the financial team kind of gathers and says, hey, the advisor says, this is what's at risk. This is the total net worth. The CPA says, hey, we need to create a tax neutral strategy here. And the attorney says, okay, based off of what state we're in, based off of a case law and precedent, based off of judgment limits, this is the structure that I recommend, be it irrevocable trusts or onshore, offshore, structuring titles the right way. That's where the professionals get involved. And then finally, the third leg, I think it's more of a something you owe yourself from a thought experiment is if you don't understand how a lawyer would bring suit against you, regardless of the merit of the claim, if you don't understand how contingent fee lawyers work or what their decision calculus is when they decide to take a case against you, I think it's worth understanding in your state specifically what the history is, kind of the legal landscape of results-oriented judges, of contingent fee lawyers, and just what that looks like. Because, again, I think the more information you know and what you're armed with, you kind of round out this effort of truly going through the diligence of asset protection.
So from those 3 perspectives, what do you think about the idea, as part of that plan, obviously, being to separate your taxable account, your taxable investing account into 2, and putting some in your spouse's name and some in your name? Do you think that would add much?
Depending on the state, right? So TBE is limited by, 15 states, right? So, which basically says that unless both spouses are encumbered by the same creditor, that the creditor can't touch the other spouse's account. Well, if that's not the case in your state, and by the way, in a defensible position, TBE has kind of gone by the wayside. I think Florida was like the most popular state for TBE being used in kind of in defensible positions to protect assets. I don't see the benefit here in Tim's case, given where he's located and just the kind of the lack of efficacy in TBE as a one-stop shop for asset protection. And I do think it adds a kind of an unnecessary burden and complexity from the household perspective.
Yeah. Now he's talking about TBE. So he means tenants by the entirety. This is how you title your assets in some states. such that basically it says you own the whole account and your spouse owns the whole account. So mostly people are thinking about this with their house, but it can be applied to investment accounts as well, such that basically if someone brings suit against you, let's say it's a malpractice suit, and it's for some crazy reason they get an above policy limits judgment that isn't reduced on appeal to policy limits. They've actually got a valid judgment against you. And the idea is if you own the retirement or you own the taxable investing account as tenants by the entirety with your spouse, they can't take it because your spouse owns the entire thing. And they're not suing your spouse for malpractice. They're only suing you. Unfortunately, California is not a tenants by the entirety state. So this isn't going to work for Tim in San Francisco. But when a lot of people start worrying about asset protection, they forget that their biggest risk is probably their spouse anyway, right? So if your biggest risk is your spouse in a divorce, which even though dual physician couples have lower divorce rates than the general population, it's still way higher than the chances of an above policy limits malpractice judgment. And so putting, half your taxable account or all your taxable account or your taxable account and your boat and your cars and your house in your spouse's name is probably going to cause you more problems in the event of your largest risk, a divorce happening. I had a subscriber the other day who unsubscribed from my newsletter, and I often ask when people do, hey, how come you decided to? And this person said, well, I'm going through a divorce and it is too painful right now to be hearing about money every day in my email box because I realize all these great tips I put into place listening to you are just making my ex-spouse much richer. And so you got to realize that is a really big asset protection risk. So I suppose if there was, this very rare above policy limits judgment against this doc, maybe this could theoretically help. Maybe it would protect half that taxable account because it isn't owned by the doc. I haven't gone to the trouble to do this. Have you had any clients do this in the past?
No, not TBE. And again, I think it's once you go to an attorney, I think they're going to steer you away from this as a kind of a viable solution. There are better ways to protect yourself from this kind of hypothetical case of above policy limit judgment than just solely relying on title. It may be part of the equation, but I think it's fallen out of favor as an exclusive solution.
Yeah. Okay, so let's take Tim's next question here. Let's listen to that.
Hi, Jim. This is Tim in San Francisco. My family is pretty early in its investing career, and I am interested in exploring the idea of using margin to essentially borrow to fund our future financial independence. I know Interactive Brokers has relatively low broker margin interest rates. I was wondering if you had any experience with this, and if so, what your experience has been like. What do you think is a safe total proportion of margin loan to have in a portfolio? 10%, 20%, 30%? Thanks so much. Bye-bye.
Okay, so here he's talking about margin and really asking how much margin is a good idea to have in a portfolio. What would you tell him on that question?
I think that's probably the wrong question to start with. And so, we liken things probably because we have simple minds back to things we learned as fighter pilots. And one of the first things you learn is that if you ever show up to a fair fight, you've done something incredibly wrong, right? You should never show up to a situation where the odds are not stacked in your favor. Immediately, when you start levering up, you stack things against you, unless you can create a situation where you do have an unfair advantage. And I think that you can create an unfair advantage in certain situations where there's an information asymmetry, where you may have an insight into a particular geography as far as like real estate is concerned, or maybe a particular industry or private markets. But before we even get to creating that edge, so to speak, where it makes margin or leverage kind of a sensible plan of action, we got to look at what are your debt ratios in aggregate. Right? If you're looking at your personal finances, you need to understand all of the debt ratios that a corporation would do. And so when you run your personal finances like a business, you got to understand your willingness and your ability to accept risk, which may be more mutually exclusive than people realize. You got to understand what are you using this margin or leverage for, and how does that tie into longer term goals? What are the risks associated with that may derail the plan? And then from there, you kind of establish, okay, what information asymmetry can I exploit that would put me back into an unfair fight with the odds stacked in my favor. And Jim, I think you mentioned here the no margin calls. And yeah, man, I completely agree. If something is illiquid and there's no mark to market on it, no one's answering the question that no one wants to ask of, well, what's the true value of this? And so no one's calling you on your margins. And so I think that before even getting to this, how much margin is a good idea to have in a portfolio, there's a whole litany of questions we need to answer before then.
Yeah, most people, especially early in their career, they're already very highly leveraged. If you look at a typical 35-year-old doc, they've got $200,000 or $300,000 or $400,000 in student loans already. Maybe they have a practice loan for $500,000. Maybe they've got a $500,000 mortgage. They've already got a ton of leverage in their life. And now we're talking about adding more into their life. I don't think I'd really encourage that sort of behavior. Then later in life, hopefully you've kind of taken care of this debt issue. You really don't need to take that risk to meet your financial goals. Most docs don't have to use margin. You just carve 20% out of your high income, invest it in some reasonable manner, and you're going to be financially independent in not that long. If you do choose to do margin, you're limited to 50% of your portfolio. That's the most you can borrow against. But I wouldn't get anywhere near that, because that's where you start seeing margin calls as assets start dropping. You hit a 2008 kind of scenario and you're going to have some serious margin calls. And if you had enough money to meet those margin calls, well, maybe you should have just invested that in the first place instead of holding it in cash, But if you really wanted to leverage up, I think the place to do it, again, as you mentioned, is the non-callable stuff. Your refinance student loans, your mortgage, home equity line of credit, that sort of stuff, rather than going to interactive brokers and taking out, a margin loan. Although they'll give you a relatively low interest rate, I think they're 2 or 3 or 4%, something like that. You do face the possibility of a margin call. Before I did something like this, though, I would encourage you to go back and read a thread. This is kind of a classic thread on the Bogleheads forum. It was started in September of 2007. And if you know your financial history, you can kind of know what's coming, right? This was a fellow by the name of Market Timer, was his avatar on the forum. He was an economics student, a graduate student, I think, as I recall, who called this thread a different approach to asset allocation. And basically his idea was to mortgage your retirement, borrow all this money early in your career, and then gradually deleverage throughout your career. Well, this attempt at using leverage in his portfolio blew up spectacularly a year later. And it's all documented in real time as this thread goes on. And so I would encourage anybody even considering adding a significant amount of margin in their portfolio to really read what it looks like when it goes bad. Because when it goes bad, it's pretty ugly. Luckily, this guy was smart enough and hardworking enough that he eventually recovered from his huge mistake of trying to mortgage his retirement. But it wasn't before losing several $100,000 that he really did not have. And he's humble enough and, into it enough and anonymous enough probably that he kind of shared all the gory details. But it is worth a read if you're really considering adding leverage to your portfolio. It's not something I've ever really done. And I just don't think that a typical doctor needs to do this to meet their goals, So, all right, let's move on to the next question. This one is about mega backdoor Roth IRAs, which is what I titled this podcast as. Let's listen to it.
Hi, Jim. Could you further discuss the mega backdoor Roth IRA? Specifically, who is eligible, what advantages does it provide, and any legal or tax documentation that needs to be completed in order to do a mega backdoor Roth IRA conversion properly? Could you also discuss the utility of after-tax traditional 401k contributions, even if a mega backdoor Roth IRA is not possible? For example, does after-tax 401k contributions provide the same asset protection benefits that a pre-tax contribution would provide? So here's some additional background about myself. My wife and I are both W-2 employed physicians, and we are already maxing out our respective 401k and 403b accounts, backdoor Roth IRA accounts, and HSA accounts. My employer-sponsored 401k does allow for in-plan Roth conversions of after-tax traditional 401k contributions. However, my wife's 403b plan does not allow this. Thank you again for everything you do. You've really inspired my family and me to take control of our finances.
Okay, so it sounds like he wants to hear about, mega backdoor Roths, who they're helpful for, how to do them right. and then also a little bit about after-tax employee contributions that aren't converted to a Roth. You want to talk a little bit about that? You know what he's talking about there with the mega backdoor contributions?
Yeah, and it's an incredible opportunity if the plan allows it. And so just before we start, getting everybody excited about the mega backdoor Roth, it's not a guarantee by any means to all 401k plans. Your plan needs to allow after-tax contributions. And, from what we see from being Erisa 338 and 321 fiduciaries is when we look at plans, depending on the industry and the size of the business, about 50-50 of those that allow after-tax contributions, even less allow in-service distributions to a Roth, even less of that. Some actually provide kind of systematic valuation to the Roth portion of the 401k. And so again, we're always going back to this first question of it's a level of diligence that needs to be executed to understand what's available to your plan, how it works. Because at the end of the day, what you're doing is you're contributing after-tax dollars. And so you are trying to achieve the maximum $56,000 in 2019 of the qualified plan. Obviously, beyond 19,000, assuming you're younger than 50, not playing a catch-up game, you get the tax break on, and then above and beyond that, you don't get any tax. There's no pre-tax benefit. So you're paying taxes on it, but you're contributing to the plan. Those contributions are going to grow tax deferred until you do something with them. And so that do something with them could be distribute them to a Roth IRA. They're after tax. They're eligible for rolling into a Roth IRA. The earnings portion of those dollars, when you distribute those or roll those over, those will end up in your traditional IRA. And so it's a fantastic way to supercharge retirement savings. It's a fantastic way to, if you're excluded from contributing to a Roth due to income, it's a great way to square that corner. It just requires some understanding of what your plan allows, what it doesn't allow, and then certainly knowing what it looks like from a tax perspective to get your 1099-R when you do make those distributions, and how you report that distribution or rollover from the plan into the Roth IRA. So it requires some work, in my opinion, if your plan allows it, and certainly if it doesn't create a liquidity crunch for you, no cash crunch, you have the excess capital to put into retirement savings. Back to our asset protection, obviously an Erisa plan is a great place to protect assets. We could go on and on about the benefits of the mega backdoor Roth. There's just a little bit of work to be done ahead of time to understand, so that everyone understands, one, if the plan allows it, and two, kind of your responsibility of keeping up with the tax data and tax forms that will be ultimately reportable.
Now, your firm sets a fair amount of retirement plans up because you guys function as 338 fiduciaries on them. Do the plans you set up usually have this as an option for people who want to do a mega backdoor Roth IRA?
We've seen this shift down market for plan providers to kind of replace your standard insurance companies and payroll providers that have typically put in plans for small businesses. That's great, because I think it's the pricing is better across the board. The issue is that in order to achieve that scale and reach down market, what you see are a lot of volume submitter packages and basically boilerplate language. And to be honest, we don't see a whole lot of, in the small business space, which is kind of where we work, we don't see a whole lot of plans that right out of the door have these options built in. Now, that being said, it is well worth investigating, when it may be time to kind of go through a restatement of the plan or amend it, talking with your TPA or record keeper about, hey, can we restate the plan to add in the ability to accept after-tax contributions, in-service distributions? Certainly, if there's no Roth component to the plan, that's low-hanging fruit. It is always worth asking the benefits coordinator, or if you're on the 401k committee, those are great conversations to have. Unfortunately, in the small business space, we just don't see that as kind of commonplace elements of these mass-produced, low-cost 401ks. That is not to say that they're not out there. It just, you really have to go ask the questions when you go through the plan design phase.
Yeah, it pretty much has to be a customized plan most of the time to get that in a small business plan. For those who are lost, they totally got lost in the last 2 minutes on this podcast, let me step back for a minute and explain what a mega backdoor Roth IRA is. Hopefully, you're already familiar with a backdoor Roth IRA. This is where you put money into your traditional IRA, $6,000 a year, then convert it the next day or the next week or whenever to a Roth IRA. That's the backdoor Roth IRA. Now, a mega backdoor Roth IRA has to do with a 401k plan. Basically, in your 401k, you're allowed to put in an employee contribution if you're under 50 of up to $19,000 per year. Now, the total of your employee contributions and any employer contributions into that plan can be $56,000 a year. So if you get a big fat match, then maybe you can get to $56,000, but there's a lot of people that don't get that much of a match, and so they're just not able to get anywhere near that $56,000 limit. But there are some plans that the way they're written, they allow you to make after-tax contributions to the 401k. This is money that has already been taxed. You're not getting that upfront tax break like you are the employee contribution to the 401k. It's just after-tax money. When it comes out eventually, you won't pay taxes on it, but the earnings will all be fully taxed at your ordinary income tax rate when it's pulled out of the account. And so that's like, well, it's not super attractive unless there's one other provision in it. And that provision either has to allow you to pull money out of the plan despite not leaving the employer, right? This is an in-service distribution, or allow you to convert it inside the plan into a Roth 401k account. And then that thus becomes a mega backdoor Roth IRA because you put in all this after-tax money and then you convert it right away into a Roth IRA. And then the earnings are tax-free forever and none of that ever gets taxed again. And so that's a pretty great deal if you've got it and want to do that. So Katie and I started doing that this year kind of for a different reason. We were able to put in $56,000 in tax deferred money if we wanted to. But the issue was, as business owners, the owners of the White Coat Investor, it was lowering our 199A deduction. Yeah, all that money we were putting in there as employer contributions. So we decided we'd stop doing that and just do mega backdoor Roth IRA contributions. But we had to leave our Vanguard individual solo 401k because their boilerplate, plan document didn't allow this. And so we went and got a customized one that did allow it. And basically that's what we're doing for our contributions this year. But lots of people through their 401k at the hospital or their practice or whatever, they can do these mega backdoor Roth IRAs. You just have to make sure the plan, number one, lets you contribute money after tax, and number two, lets you either convert it inside the plan or pull it out of the plan despite not leaving the employer and convert it yourself into a Roth IRA. So that's what we're talking about, is these mega backdoor Roth IRAs. But the other question that was part of this was, what do you think about after-tax employee contributions that aren't converted to a Roth IRA? So the plan allows you to put in that money after tax, but doesn't allow you to do an in-service distribution, doesn't allow you to do in-plan conversion. What do you think? Do you think those are worth making, or should you just invest in a taxable account?
Well, you can always wait until you terminate employment, and so now you're playing the long game, maybe. Or if you know that you have a different life plan over the next few years, and you can take the distribution upon termination or separation of employment, that's something to consider. I would just mention the fact that from an asset protection perspective, that certainly an Erisa plan like a 401k is a great place to hide money, so to speak. And so in this tax environment, I'm always challenged to find a compelling argument against opportunities to get money into a Roth, right? Because when you look at historically post-war years, World War II years, most brackets are the lowest they've ever been. And so, when you start looking at structural requirements down the road, as far as the demography of the United States and our liabilities, taxes are probably going to increase. And so that makes the Roth even more attractive. And so there's a little bit of bias on my part that would say, hey, this is still an attractive option if they don't allow in-service distributions or valuations to a Roth element of the plan. Just keep in mind that you do have to wait until separation or termination of employment before you can effectively roll that into a Roth account.
Yeah, certainly if you're leaving in a year or two, there's a pretty good argument to make the contributions. If you think you're going to be there for 30 years, maybe you're better off in a taxable account. Because the problem is you're turning earnings that could be long-term capital gains into ordinary income. And without getting that upfront tax break that you usually get with a retirement account. So you're weighing a few things there. Most of the time, it's hard to say if it's worth it without really getting into the details. So for those just tuning in, I've had Aaron Millage on here. He is with Targeted Wealth Solutions. You can learn more about him and ask him more questions at targetedwealthsolutions.com. You can email at info@targetedwealthsolutions.com or give him a call at 303-800-8179. Aaron, thanks for being on the White Coat Investor Podcast.
My pleasure. Thanks for having me.
All right, I've got another question from Tim here. This is great, Tim. You're really feeding our podcast today. It's great also that he left a name and where he's from. So if you don't mind, do that on the SpeakPipe questions. I know a lot of you like to remain anonymous, but it does add a little bit more personality to the show when you leave your name and where you're from. So let's listen to his next question.
Hi, Jim. This is Tim in San Francisco. I've been reading about how ETFs work. I was curious about the authorized participant's role in flushing out capital gains. Why would an authorized participant be willing to accept shares with the lowest basis? Wouldn't the capital gains taxes they would have to pay negate any ability for them to arbitrage and make money? Thanks.
So why would ETF authorized participants be willing to take the lowest basis shares when ETF units are liquidated? Well, I'm not sure they actually get a choice. I think they just got to take what they're given. It probably reduces the returns, but these are smart people with very powerful computers. I'm sure they can calculate out whether it makes sense for them to liquidate that ETF if there's an arbitrage there or not. Remember, these authorized participants are able to form these ETF shares and disform them. And they're the only authorized people able to do that. And so when they see an arbitrage opportunity between the prices of the securities and the prices of the ETF shares, they can swap them out basically and take the shares and sell them. For most of us, that would be very unwieldy to do. And this really benefits us because it keeps the market very liquid and priced appropriately. And so it's a benefit to all of us to have people doing this. But as far as answering your questions, I don't think they get a choice. I don't think they're able to ask for the shares they want. And so the fund company can use this mechanism to flush out the lowest basis shares out of the ETF and make the ETF, and in Vanguard's case, the ETF and the traditional mutual fund shares a little bit more tax efficient. That's a great question, though. If I ever meet one of those authorized participants, I'll try to remember to ask them that question. All right, the next two questions we're going to do here were actually aimed at my discussion with Michael Kitches a few weeks ago. We weren't able to get them in. As you may have noticed, Michael is a little bit talkative, and we certainly didn't get all the questions you guys wanted us to get on that podcast. So I'm going to try to answer these two myself. Here's the first one.
Love both your podcasts. I'm a 62-year-old physician retiring in 5 years. Michael, I followed your discussion of equity glide paths by which equity positions increase during retirement. But you start at 30% equities on day one of retirement. I'm now at 60% equities, 20% of which is in retirement accounts. Would you really make a dramatic and tax inefficient move to lower my equity position on day one before I retire? Hey, thank you.
Okay, basically we're talking about bond tents here. What a bond tent is this idea that was kind of made popular, I think mostly by Wade Pfau in the last couple of years, that to reduce your sequence of returns risk, the period of time that matters the most is the 5 years before you retire and the 5 years afterward. And so that's actually when your asset allocation should be the least risky. Right? You have mostly bonds, this extra amount of bonds in your portfolio, this bond tent, in case the terrible returns in your 30-year retirement period show up in the first 5 years. That's what it protects you from. And then the idea is that after those 5 years or so, after you retire, you start increasing your equity percentage in your portfolio. And so the bond tent is this period of time around the date of retirement in which you have a less risky portfolio. So in the case of this questioner, he's talking about going from 70% stocks to 30% stocks. I think what most people do is rather than making a dramatic shift, which obviously introduces some elements of market timing, is they do it more gradually over a 5 or 10 year period. If you want to be at 30% stocks for 5 years before and after your retirement date, I wouldn't recommend going there all in 1 year. I'd try to get down to there over a course of 5 or 10 years. And I think that's probably the way to do it rather than a dramatic shift. All right, let's take the second question.
Michael, you're such a clear thinker. Many talk about high dividend paying equities or funds as being superior in retirement because they generate income. They don't consider that selling appreciated diverse stock funds is an option. But the tax rates are basically the same. What's your view on dividend investing for retirement? Thank you.
Okay, so what do you think about high dividend equities or funds? I'm not a big fan of this approach to getting a value tilt. Now, there are people out there that swear by dividends. They just think dividends are the cat's meow, even though in reality, as far as from an accounting point of view or a taxation point of view, a dividend is nothing more than selling shares at a long-term capital gain. It's like a forced sale of your shares when you may not even want the cash. And so it's not necessarily ideal to declare a dividend, because it's costing your investors some taxes if they really didn't want the dividend. The idea, though, that these dividend investors have is that if company management have to pay dividends, then they'll manage the company better. And if they look back over the historical records, they see that these companies that pay dividends have better returns than the overall market. But in reality, what that is just a manifestation of the value factor. This idea that value stocks over the long run have better returns than growth stocks. And that's likely because the companies are a little bit riskier, although there are some behavioral aspects to that. But it turns out if you want a value tilt in your portfolio, that a dividend tilt is not necessarily the best way to get that. It's not a terrible way to get that. If you want to tilt your portfolio toward dividend producing stocks, that's okay. I mean, I tilt my portfolio toward value stocks, but it may not be the very best way to do it. So I'm not a huge fan of it. I certainly don't think there's something magic about dividends like a lot of these kind of dividend diehards you'll see out there. I mean, there's 1,000 blogs on the internet dedicated to dividend stock investing. Most of them don't understand the concept of uncompensated risk of individual equities, but just realize that there's a lot of behavioral and psychological aspects to this. All right, let's take our next. This one's not so much a question as a comment on the SpeakPipe. Let's listen to it.
I would just like to make a comment on one of your latest episodes where you're interviewing the pulmonary critical care physician and kind of going into her finances. I absolutely loved that episode. It was so enlightening. It's great to hear you just talk to someone like me who's a physician and kind of go through their entire portfolio, their entire life in terms of their finances, and then kind of diagnose what she needs to do. So I feel like more episodes of that would be awesome. For example, if you did, at the very least, maybe an episode a month of just talking to a normal person and kind of going through that. I would love to be a volunteer, but just in general, just wanted to let you know, I absolutely love that episode. It was very informative. And if you could continue to do those type of episodes, I would be very grateful. Thank you for everything that you do. And thank you.
Okay. This is the episode we had a few weeks ago, where we brought somebody on and kind of did a deep dive into their finances. I got tons of great feedback on that episode. Everybody loves them. Unfortunately, nobody really volunteers to come on and talk about their mistakes and be M&M'd in front of 25,000 docs. Nobody seems to want to do it. I get a few people that want to come on and talk about all the success they've had in their life, but that's not really what you guys want to listen to. You want to listen to the mistakes people made, which are just like your mistakes and just like my mistakes, and talk through them. So if you've made a few mistakes in your life, and you feel like that it would make a good episode to do a deep dive into your finances and you have some questions about it, well, shoot us an email. We do put those episodes on and people love them. So let's do a few more of them. All right, next couple of questions came in by email. These are two questions from the same doc. The first one, I've got $32,000 in a rollover IRA. My expected income in 2019 is $175,000. Is it worth rolling my $32,000 in a rollover IRA into a solo 401k in order to do a backdoor Roth IRA? I know I can convert the entire thing, but the taxes would be high because I'm a California resident, and converting would only help me for the 2019 year because I'm going to be using a simple IRA as my employer provided retirement account going forward. Oof. I'm not a big fan of simple IRAs. I understand it's the right thing for some small practices, some small business to use a simple IRA. But a simple IRA does not have a very high contribution amount. You got to leave the money in there for 2 years before you can do a rollover or a transfer. And it is counted in the pro rata calculation for a backdoor Roth IRA. And so they're not great. And so I feel bad for those docs who are forced to use them. The truth is, if your main retirement account going forward is going to be a simple IRA, a backdoor Roth IRA probably is not in the cards for you. It's probably not worth the hassle. If you're only going to be there for a couple of years, sure, do the contribution step and just don't do the conversion step for a backdoor Roth IRA. But for the most part, if this is your long-term plan, maybe you're just not one of those people that are going to use a backdoor Roth IRA. As far as this $32,000, it can be converted and you can just pay the taxes. Maybe you'll pay 10 grand in taxes on that. If you can afford that, that would be fine to do. And then of course you'd be able to put $6,000 into a backdoor Roth IRA that year. But that's probably it, given that you're going to be using a simple IRA going forward. And so I may not bother with it. I may just hold on to it as a rollover IRA for now and just resign myself to the fact that I wouldn't be able to do a backdoor Roth IRA going forward. Remember, of course, that IRA stands for individual retirement arrangement, right? It's individual. That means even if you can't do one because of a simple IRA, that doesn't mean you can't do a spousal IRA for your spouse. So if your spouse is a stay-at-home parent or, if they do whatever, if they're working, you can still fund a backdoor Roth IRA for them, even if you have a simple IRA at work. And remember, when I'm saying simple IRA, I'm not talking about your basic traditional IRA. A simple IRA is a separate type of retirement account that the self-employed use, that employers use for their employees. It's called a simple IRA, and it's always capitalized, SIMPLE. Stands for something. I can't remember off the top of my head what it stands for today, but that's not just a traditional IRA. Okay, the second part of the question. As a resident fellow, I maxed out my Roth IRA every year. The only issue going forward is that my new employer only offers a simple IRA, including a 2% salary match. I know that simple IRAs prevent rollovers for 2 years from the initial contribution of funds, which would not allow me to do backdoor Roth IRAs because of the pro rata rule. What do you recommend I do? Well, I probably just wouldn't do backdoor Roth IRAs going forward, as I mentioned. Okay, another question from Tim from San Francisco.
Hi, Jim. It's Tim in San Francisco. What do you think about Vanguard's Total International Bond Fund? Should we use it for relatively short-term savings goals? Should my mom use it in her retirement account? Thanks.
Okay, what do I think of the Vanguard Total International Bond Fund? Should I use it? Should my mom use it? Etc. Okay. Vanguard likes it. No surprise, it's their fund. They use it in their target retirement funds. I've never actually owned that particular fund. There are dozens of asset classes out there. You don't have to invest in them all. There are no called strikes in investing. Certainly, international bonds are a reasonable asset class to include in your portfolio. But here's the deal with bonds. If bonds are only 10 or 20 or 25% of your portfolio, you probably don't have to have a very complex bond holding. Maybe you only own one bond fund, a total bond market fund or an intermediate bond market index fund or something like that. If you've got 50 to 80% of your portfolio in bonds, you probably want to break it up into a few different bond asset classes. And maybe that's the type of person where international bonds or Treasury inflation protected securities, TIPS, bonds are appropriate to include in the portfolio, etc. But the whole key to building a portfolio, building your asset allocation, is to pick something reasonable and stick with it. If you like international bonds, it's okay to put them in your portfolio, set them to 5 or 10 or whatever percent of your portfolio that you want them to be, rebalance it periodically and go forward with it and stick with it. They will have their day in the sun just like every other asset class does. But I don't find the argument hugely compelling for those of us early in the accumulation phase to add this fund to a total bond market fund just for completeness sake. So you have all the bonds in the world. I don't know that bonds necessarily need to be diversified quite that much like stocks do. I'd be much more likely to add an international stock fund to my portfolio than I would an international bond fund. All right, next question.
Thank you very much for all your financial wisdom and financial polls. I have a question regarding non-qualified deferred compensation. My new employer is offering non-qualified deferred compensation where I can contribute up to $50,000 a year, but in spite of that, my tax bracket will still remain the highest when I do married filing jointly due to our combined high physician salaries. My question is that should I still contribute to non-qualified deferred compensation at all, as it is non-qualified and risky in the future, though my employer currently is very stable? I have been maxing out my other retirement contribution and Roth contributions every year, along with I also have brokerage account. but my new employer will be contributing $17,200 every year to my deferred compensation account, irrespective of my contribution. So I think that could be a substantial amount accumulating till the time I get a distribution or there is a termination. Can you please give me the details of non-qualified deferred compensation plan? I did read that it is largely illiquid. The terms are generally irrevocable. Once it is set, is risky and not protected from creditors. I do know that I don't pay income tax, but pay FICA and FUTA tax the year I defer compensation. But is it that I can only access it after retirement, or I can keep a term of 5 years or 10 years? Is there anything else I'm missing about deferred compensation? And should I defer any amount of my gross salary in deferred compensation? The funds in the deferred compensation are Vanguard funds. Thank you again.
Okay, so this is about a deferred compensation account. Should you use it? Well, these are basically the same as a 457B. It's deferred compensation. That means the money still belongs to your employer. So the number one consideration is whether that employer is stable. If the employer goes under, you could lose the money. It's asset protected from your creditors, but not their creditors. You also want to make sure it has reasonable fees, reasonable investment options, and reasonable distribution options. If you have to take all the money out the year you leave, that's not reasonable, right? If you put $200,000 in there and now you got to take that all out the year you leave employment, that sucks, because that's basically going to be an extra $200,000 in taxable income on that money. And you may end up paying a higher tax rate on it coming out than you did going in. But if you can spread that out over 5 or 10 years or longer, or you can roll it into an IRA like a lot of governmental 457 plans, then it can make a lot of sense to use that 457 plan. Likewise, if all the investments are terrible or there's some type of weird insurance product, maybe you'd rather just use a taxable account than that deferred compensation account. But the most common issue is that the distribution options just aren't very good. So make sure you understand how that money comes out of the account before you put the money into the account. There's no standard out there. Every plan is different with respect to these. So you have to read the document and really understand what's going on and make a smart decision. Just remember, even if the plan isn't perfect, you may want to put some money in there, even if you don't max it out. You know, maybe you don't max it out every year for 10 years. Maybe you max it out for a year or two, or maybe you just put $5,000 a year in there. It's not an all or nothing decision. You can always go halvesies and put half of the extra money you have to invest in that and half in a taxable account. Okay, I got this question by email. Another one, a little bit about savings accounts. They say, I read in your financial bootcamp book that it may be a good idea for high-income professionals to use the Vanguard Municipal Market Fund, money market fund, as a savings account, especially if you live in a tax-free state such as Florida. I just wanted to confirm that I interpreted that correctly. I was planning on putting excess cash into the Vanguard Municipal Money Market Fund after I've maxed out all my tax-exempt retirement accounts and Backdoor Roth. In addition, I have a 2.3% high-yield savings account at a bank. Thanks for your input. Well, the key with these cash equivalents, these money market funds, these high-yield savings accounts, is to do a calculation. And that calculation is you take the yield of the taxable account and you multiply it by 1 minus your marginal tax rate. So if you're in 37% tax bracket, you take the yield of the taxable account, multiply it by 1 minus 37%, or 0.63, and that tells you the equivalent yield on an after-tax basis. So you then compare that to what the municipal money market fund is yielding. And if it's the municipal money market fund is yielding more, like it usually does for those in the highest tax brackets, then you put your cash in there. If it's yielding less on an after-tax basis, then you just keep it in the taxable account and you pay the taxes. You know, lately, the last couple of months has been a little bit wonky. Those of us in the highest tax brackets, sometimes it has actually worked out better to just be in a taxable money market fund or a taxable high-yield savings account. So periodically, you might want to recheck that. Occasionally, the yields of munis versus taxable bonds and money market funds does change a little bit. So keep an eye on it. But the key is to do that calculation. All right, here's another question that comes out of the Facebook group. I'm fresh out of training. Our family likes to travel. I was wondering, how much should I spend each year on vacations? Is there a formula like 5 to 10% of post-tax income? Well, first of all, you're fresh out of training, right? So you're supposed to be in your live like a resident period. So it's okay to go on a vacation if it's a kind of vacation that a resident can afford. You know, oftentimes that means driving on a road trip or staying with family or doing it on the cheap or using airline miles to pay for it, that sort of a thing. And then generally, after your live like a resident period, my recommendation is that you save 20% of your gross income for retirement, save enough for your kids' college, enough to have your house paid off by retirement, and then you can spend the rest guilt-free. There's no magic number of 5% for vacations or whatever. If you're a car guy, go spend the extra on a fancy car. I don't know, Maserati or whatever you car guys are into these days. If you love to travel, well, spend it on vacations. So what if you spend 15 or 20 or 30% of your gross income on vacations? If that's your thing and you want to live in a shack and drive a beater but go on these awesome vacations, then do that. Right? But you got to balance everything else out and make sure you're taking care of business. 5% sounds reasonable to me at the stage I'm at in life, but there are periods of time in my financial life where 5% would have been way more than I should have been spending on vacation. So you just have to look at your overall budget, make sure you're working toward your goals, and then decide how much you're willing to spend on vacation. Okay, another one from the Facebook group. I'm holding the Vanguard Total Bond Market ETF in my taxable account. I want to exchange it for something more tax efficient, such as a municipal bond ETF. Okay, that seems reasonable to do. That's not a bad idea if you are going to try to have a little bit more tax efficient portfolio. You can also simply take your bonds and invest in them in your tax protected accounts and put stocks. A total stock market index fund, total international stock market index fund, that sort of a thing into your taxable account as well. This question also asks, if I identify a loss and do this exchange, does that count as tax loss harvesting? So yeah, that's great. If you can sell something, but you're going to sell anyway and get a loss out of it, then you can use that to offset up to $3,000 a year of your ordinary income. And beyond that, any capital gains you may have. Okay, so while I was gone recently on a trip, I got a couple of emails of people asking about an interview that Michael Burry did. Michael Burry is the guy in The Big Short. He's the doctor who left medicine and went and ran a hedge fund and resisted all of his investors' calls to stop doing what he was doing and made a big call right in 2008 and made gazillions of dollars for himself and his investors. And so in this article, basically, he talks about things like that index funds are a bubble and those sorts of things, and gives some warnings about that. And people ask me what I thought about that. Well, I'm not a guru. Maybe Michael Burry is a guru, but here's what I've learned. Nobody knows what's going to happen in the future. Michael Burry's crystal ball is just as cloudy as everybody else's, right? Just because he made one call right in 2008 does not mean that he knows the future about everything going forward from here. So take anything everybody says with a grain of salt, right? And try to have a plan that doesn't require you to be able to predict the future in order to meet your long-term goals. I really don't buy this index funds are in a bubble argument. And the reason why is, yes, a significant portion of the market is indexed, but a significant portion of the trades in the market are not indexed. They are being made by active managers who are trying to do price discovery and discover what the value of the various securities are. And so they are determining as they go along what they think a company is worth. And that those people who are making the trades are the ones who are determining what the value of the security is, not the people who are buying and holding it for 30 years. They're not making any contribution to what the value of that security on a given day is. And so I am not worried until a much larger percentage of the market is in index funds that is somehow going to cause the market to be less efficient. There will always be people like Michael Burry out there trying to find the stocks that are underpriced and buy those instead. I just don't see this scenario where index funds are going to go down and the overall market is not, or that somehow index funds are going to drop more than the market, or that a significant percentage of the market being in index funds is somehow going to inflate stock prices. I don't buy it. If the stock market goes down, yeah, your index funds are going to go down. Maybe the tracking error gets a little bit larger, but it is so tight right now, it could triple and you wouldn't even notice it. That's much less of an issue anyway for a long-term investor like me than it is for someone running a hedge fund like Michael Burry. But at any rate, I stopped believing in anybody's ability to predict the future well enough to provide actionable information a long time ago, and I suggest you do the same. So our sponsor for this episode was Earnest. Earnest is really great because you can choose custom terms to fit your budget. So you can pick your exact monthly payment, or you can select your interest rate, or you can select the term, which is what most people do, is they decide how long they want to pay, and then Earnest tells you what the interest rate for that term is going to be. You can get fixed and variable rates. They don't pass you off to third-party servicers. They don't penalize you for making payments early. They protect your family in the event of your death or disability. And the minimum amount to refinance is super low, $5,000. And the max amount is pretty high, $500,000. So if you have debt between $5,000 and $500,000, you can refinance with Earnest. If you go through the link I'm about to give you, you can get $500 cash back as well. And please put that toward your loans and pay them off even faster. That link is whitecoatinvestor.com/refi, R-E-F-I. Refinance today with Earnest. Be sure you sign up for our email list. You can find that at whitecoatinvestor.com/email. Also, give us a 5-star review on the podcast. Tell all your friends about it. Head up, shoulders back. You've got this, and we can help. We'll see you next time on the White Coat Investor Podcast.